first on this one, but before I do, I want to talk a little bit about where we're headed. I want to talk about the retail investor. And the reason why is retail investors and the Main Street investors are so important to state regulators. And they're important to everyone on this panel just because they're just kind of the heart of what we're looking at here. So I want to talk about two main things. I want to talk about the gamification of the markets, and I want to touch on the social media piece and how this has, there have been some similar instances to GameStop in the past, but this is completely different when you tie in the social media aspect and the number of younger investors. And that's where I want to go first. So while some have seen this as a great way to get younger investors involved, because I think we all know they're the kind of the least experienced group, they're less younger investors in the market. And some say this is a great way to get them interested in the markets. Others say it's not really investing at all, and it's more like a casino. And so because of that, it hurts the market overall. And even Chair Gensler noted in his testimony that even for some of the apps that we're talking about, that we've kind of lost that human in the middle. So how do we ensure the suitability? How do we ensure the appropriateness of the investments? So that's kind of my forward. And my first question for Katrina is going to be, so one brokerage firm did report over 3.2 million new accounts opened in 2021. That was more than all of 2020. Another one reported new accounts up 300 to 400% during the first quarter. So is this influx of retail customers a positive or a negative for the markets? And I guess more than that, if you could just touch on what are the implications of that retail investor influx? I know that's a lot for a question, but Katrina, if you just want to talk about more than anything about the number of retail investors, how it impacts the market, or just any opinions that you have.
Yeah, absolutely. Thanks, Marnie. I think looking at the data that we've been looking at here, we've seen retail trading volumes surpass institutional volumes, which has never happened before. I read that the DIY sort of direct and do-it-yourself trading apps are the most downloaded apps on the App Store. I think, this has clearly been exacerbated by the circumstances that we're in with the pandemic and COVID, and obviously the evolution of technology. I do think it's important to recognize that this is not going to be this influx of retail activity and flurry of those types of accounts being opened is not confined to just the COVID sort of circumstances we're in. I think it's how people want to access the markets now. The majority of people have been raised with this types of technology and are buying everything from their phones. And this is just another product that they can order on their phone, like their food or their ride or their clothes or whatever it might be. And it's kind of the whole view of, I want it now and I want it on my phone. So how do we deal with that? Well, I think the regulators are, at least here, are asking a lot of questions about, as a result of this, how are people accessing their information on the platforms, these direct investing platforms, and what is going to be the impact on the market? Increased volatility, likely. But the bigger question is, and the more significant question in my mind is what about the effect on the integrity and quality of the market? And I think that these are things that we're going to have to sort of take a look at and really dig into, because it's the market integrity aspect that is, at the heart of what we do as regulators. I don't think this retail activity is going back in the bottle. I think it's empowering for people, and I think it's not our place to tell people how to spend their money. But at the same time, how do we protect investors appropriately? And how do we address social media as the source of investment information without sort of identifiable authorship of this information a lot of the time? I think that the increasing retail activity is a good thing generally, especially in an economic environment where interest rates are so low. There's not a lot of opportunity for people to be generating income. So, I just think it's a new phenomenon for us as regulators to probe and to look into, and it forces us to look at this new cohort of investors, the gamification element, all of that. they're savvy with technology and social media, but probably not as savvy, or maybe not interested in sort of the fundamental traditional type of information about companies. I think we need to think about our investor protection hat as regulators a bit, and see how we can make sure that people know what they're buying on these platforms and the way that people are accessing the market. So I'll start with that. Let someone else jump in.
So I just had a couple, which is, I think in the state regulatory space, that there's often that talk of like the mom and pop investor. And I like to think of these folks as the TikTok investor, because they're just fundamentally different in terms of, previously you might have been concerned about a brick and mortar branch and what kind of activity was happening there, and a free lunch seminar and, those sorts of things. And this is just, while all of that may still be happening and it's still important, this is just a new flavor. I read an article on Friday that I thought might give this group a little bit of comfort around how big of an impact the pandemic had on bringing these folks out. And so, to distinguish between people that do want to buy in their account from their phone, but are investing in more traditional ways in terms of, versus buy and hold as opposed to day trading. There's a Financial Times article last week that said that U.S. equity market volume from retail brokerage firms dropped from 18% in December to 10% in March, and that as a percentage of options trading, it dropped from 20% in January to 15% in March. And if you look at the kind of line graph, it's still higher than it was in 2019, which sort of speaks, Katrina, to your notion that it's not going away, but it has dropped precipitously as some of the lockdowns have eased and people are sort of getting back to life. So, I'm hopeful that for some of the people that were sort of have a go traders that, got into this because they didn't have anything else to do, going back outside and some of those activities may draw their attention for some time and give regulators and compliance and regulatory professionals time to kind of recalibrate and get their bearings on this. And then the only other observation I had is in a completely different vein, which is, Roaring Kitty in his SEC testimony compared himself and his Reddit group to research analysts. And I know that the states were very involved in regulating research analysts on the sell side. He was comparing them to buy side analysts and basically saying that institutional funds have teams of, he didn't use this term, but CFAs who can talk to each other about their view on a stock. And we're just using this venue. And, on the one hand, I think that that's really interesting because, gamers would have an informed view, maybe anecdotal, maybe not about the fundamentals, but I mean, he had some views about to back up his position on that stock. And so finding that sweet spot of not curtailing the benefit of informing the market by people who have a view to express, but also, the sell side analysts are massively regulated now because there's tremendous conflicts in expressing a view where you also have a financial incentive in that view being accepted by the market. So those are just a couple observations I had.
I'm going to make 4 very, very quick points, and I appreciate the opportunity. So one is more women and minorities open retail brokerage accounts than ever in history. We're at the highest percentages in history of those things. So if we want to talk about accessing the market and we want more people into the market, we've got more diverse market participants, more younger market participants than we've ever had before. 2, they're the least informed market participants that we've ever had before. So I've got a 16-year-old babysitter who is trading single contract call options in AMC. I live in Pennsylvania. If one of you folks are on the phone, I'm happy to connect you. So one of the things that's really sort of nuts about that, as we all think about it, is I'm old enough to remember that when I was a brandly new minted securities lawyer out of Duke up in New York, working at my major law firm, I couldn't get a margin account from a client. I was actually working as outside counsel for a large broker dealer, and I couldn't get a margin account from them. And I was their securities outside counsel. Now my 16-year-old babysitter is making single contract call options trades. And we have to think about the disclosures related to that. So for example, if you are a retail customer and you're supposed to be, and you want to trade options, the option disclosure document is from the 1990s, it's 188 pages, and it's incomprehensible gibberish. It is not the type of thing that if you want, my 16-year-old babysitter presumably shouldn't be trading at all, right? Let's take for a moment that maybe with the oversight of a parent or what have you, that they were to try to read that disclosure, it's not useful and manageable to them. So rethinking what the disclosure obligations are and what education ought to be hinged upon it. So we want the good, more diverse people into the marketplace, but at the same time, we're clearly failing them on education. The second point to touch where Katrina was picking up, or the third point to pick up where Katrina was, which is what the heck is the market good for? Like, our members are pension funds and mutual funds who are investing for people's education and retirement. At the same time, we say, hey, we want these things to be the efficient allocators of capital so that good companies get money and bad ones don't, or at least it's more expensive. And if we want that capitalist system to work, to drive our economy and create jobs and provide reasonable risk-adjusted returns, then we don't want GameStop going to 500, back to 140, up to 200, down to 40 over the course of a couple of months. Those are the types of things that we think are not good for instilling confidence. And the last point I want to make is that instilling confidence and volatility. We in the United States have a market structure that actually maximizes volatility. If you think about stable prices, you want everybody interacting in the same place in an auction mechanism, and you want everybody who has buyers and sellers and views in all directions to sort of come together and trade. We've segmented these things, and we've made it so that the trading is actually very easy to move prices up and down. And so if we want to talk about what's stable, what makes people invest in the long term, they have to have confidence in the market. When we started this discussion at the very beginning, Steve used the word thinking about a rigged market. And that's exactly what we have to worry about. When we see all of these new investors that are coming in, I say fantastic, but I also want them to have a good experience. If they lose everything, then we're in trouble. And one of the things I think we have to worry about is that. I'm going to send it back down to Steve. Thank you.
Marnie, just a few quick points. I think there's a general consensus that expanding, participation in the securities markets is, as a general proposition, a good thing, especially, as Ty alluded to, if it's a way to promote equal access to wealth and opportunity and racial justice ultimately. But the key point is it has to be done the right way. And I would like to give a shout out to the Commonwealth of Massachusetts, because they filed a complaint against Robinhood, and it's a beautiful description of what are patently abusive gamification and promotional tactics. It's, in short, important to remember what gamification isn't. It is not really, at least done in the way Robinhood has been doing it. It's not about democratizing finance. It's about the clever use of technology and psychology to relentlessly lure and pressure inexperienced and often uneducated investors into the market at their peril. And finally, I think the point about disclosure is key, and it comes up, of course, especially in the options context, where there are just hundreds of pages of fine print, and it helps drive home the point that disclosure in this context is nowhere near enough. Nobody is going to have a realistic opportunity to read, understand, question their broker about those terms and conditions and what it really means. We actually need more than disclosure. We need affirmative guardrails, bring them into the market, but do it the right way with all the protections that are necessary to make sure they don't become losers and ultimately cynical about the markets. That's not paternalistic. That's the way the securities laws have functioned for almost 100 years.
So, Stephen, I want to play off just a little bit of something that you said. So you talked about setting up those guardrails and those disclosures. Well, what about the investors that don't have a broker? and we're talking about these online apps only, which I want to move a little bit with that. I want to add one piece to that too, the social media part. Let's talk about the Elon Musks of the world. Let's talk about some of the tweets and what they do and what people do to their investments because of that only. And when you don't have a broker and you're driving these investments on your own, then what does that mean? How is that different? And I guess, Lauren, I'll go to you to kind of talk about that first. If you could just address, I know you had some feedback with Stephen as well, but just the point that he made about guardrails and your brokers and what they should be doing.
Yeah.
Online investing and the self-driven investing, the DIY investing is much different than what we had seen 20 plus years ago.
Yeah, absolutely. And I'll actually pick up on the what's happening in the Commonwealth right now that Steve brought up, because if you read Robinhood's complaint against the secretary, they take the position that those are self-directed accounts. So that as self-directed accounts, they are not even a discussion of sort of solicited or unsolicited. And, we've talked a lot about the market integrity and the market mechanics and plumbing. And, that sort of makes me think of, the need for the market access rule when there was so much of a move from traders going to algorithms and computers, and there was going to be less human intervention, and what needed to be done there to protect the markets. And it's super interesting, with regard to the trading apps and the web-based apps generally, which is they are removing the people, as you said, Marnie, in terms of. I think a lot of investor protection had previously been based off of this notion that they would have an interaction with a broker, and we wanted to make sure that broker was well educated and understood things, and suitability is almost entirely based off of that notion of having an understanding of the client's needs and objectives and the product and how that product is going to work for that client. And those conversations are not happening at all in these instances. And so then when you couple that with some of the stuff that Stephen was talking about in terms of the push and all of the predictive analytics that are trying to draw investors onto these apps in the same way as the Facebook or an Instagram or those sorts of places, and what that means. And I think that that's a really interesting thing for firms and regulators to think about is that a type of solicitation? Is that a type of advertising? There are certain topics here that we've talked about, options and margins, and whether or not those are suitable and appropriate and who should have access to them. It's kind of a perennial issue. This is a new flavor, but it's been around for a long time in terms of, it's why Ty had trouble getting one of those accounts a while ago. It's because, that's been a known issue that we're constantly grappling with. But these are very new issues that maybe some of the regulations we have might be able to address, but maybe they can address. And then when you layer on, and maybe you need more, when you layer on what you're talking about with returns to social media and whether it's Elon Musk or, whatever celebrity, NASA and the SEC, they're constantly putting out investor alerts and other things to try to warn people that what is a good investment for Elon Musk or what he thinks is a funny thing to say is not what should be guiding your investments. It's not based on fundamentals. But, just like payment for order flow, I'm sort of dubious of the notion that even if there had been fulsome disclosure about this is why you're getting commission-free trading and that you might actually not get the best price, I think that the disclosure we're talking about has to be made in a way that if it's going to be effective, it has to speak to people where they are and at whatever level they're at, but also not be kind of paternalistic and allow them to have, a point of view, because otherwise you're just going to sort of shut them out. And that, I think, would be equally as damning as them having a bad experience and not wanting to come back for that reason. So I don't know if that addresses kind of what you were thinking, Marnie.
I think so. And I'm sure
Okay.
everyone has some commentary here. So I'm going to go to Ty first. And then
No, I appreciate it. A couple of things I want to pick up on. One, GameStop is one of the things that was most popular, but we have to realize this has actually been picking up before then. So Hertz Rent-A-Car, as the pandemic hit, was circling the drain on bankruptcy. And what was really interesting is as it got closer and closer to actually declaring bankrupt, its stock price skyrocketed. And what was really interesting is back then, Robinhood, and exclusively Robinhood, disclosed on its website how many of its accounts owned the stock. And they would, by making that disclosure, it was a self-fulfilling prophecy. More people started buying it. And they actually put out a chart, and it looked like an L. Flat line, none of their customers owned it. And then all of a sudden, as this company becomes a worse and worse and worse investment for shareholders, the number of their investors all of a sudden go through, for lack of a better phrase, to the moon. And the stock price went way up. And actually, this has happened to a number of other companies as time goes on, more recently GameStop and AMC and others. But Robinhood actually immediately thereafter stopped putting that stuff on its website. So now the market makers still have access to that information, and we could talk about that at length. But I think we have to recognize that when we're talking about the apps, we have to appreciate that things of encouragement could just be saying, how many people are buying this today in our app, right? My nephew, I don't think has ever done a lick of fundamental analysis, but he does buy the meme stocks at $20 at a time. He doesn't buy them a share at a time. Everything's in a $20 increment. And so I think we have to recognize it. The other thing that I think, particularly for state regulators, is recognizing the importance of what I would call just basic customer service. And that is where we had a suicide because someone had what is clearly an error on Robinhood's accounting mechanism and what they shared on a GUI, on a screen to their user. And he was unable to basically call a rep. And so recognizing that on the back end of all of this, there's all the stuff we can talk about, access to complex products and risky products and investor education and all that. But there's also on the back end, how do you service those customers and whether or not states have any role in making sure that, like, hey, if you have brokerage accounts for customers in our state, they should be able to call you. They should be able to have a conversation. They should be able to see the custody and understand what they're doing. Thank you.
I think that's a great point, because one of the questions that state regulators have is how can we help? How can we get involved? Because as so much of this seems to be beyond, the state level. Katrina, same thing. I know you all have different levels, and you want to look at this as what can you do? Because we're all charged with protecting investors. And when you mention specifically things like disclosures and you mentioned customer service, those are all things that we can look at. And we are getting close to running out of time. So Katrina, I want to take a few points from you and from Stephen. And then lastly, I have one final question that I want everyone to have a chance to answer. So Katrina, I will jump to you quickly.
Sure. Just really quickly, let's, with respect to these DIY platforms, I can tell you we're looking at our platforms and their model of operation where they're precluded from making recommendations, giving advice, doing sort of a trade suitability that you would get on the advised platforms. But is there a gatekeeping role for them to address some of this type of activity that we're seeing? Are they disclosing, is there sufficient transparency about fees, FX spreads? Do they do adequate onboarding processes of the retail clients at account opening? We have current rules actually we've got guidance, regulatory guidance that describes how a do-it-yourself order execution only, it's called here, model, where the line is where something crosses into a recommendation and what they need to stay away from. And I think many would say that that's served as putting a bit of a damper on the rise of gamification type of elements to the extent that we've seen south of the border, because there is a concern that a lot of those tools or features would be offside the regulatory guidance and cross into being a recommendation, which is not allowed on those types of platforms. But does that mean they can't give adequate warnings? Does that mean there cannot be a gatekeeping function? We need to look at that and perhaps provide more guidance on that in the context of these apps and sort of the platforms that we're seeing and the retail activity today.
Katrina, those are really great points, and a lot that I'm sure those of us south of the border will be happy to take a look at and take into as we try to start to analyze this from our perspective as well. And I would expect you may get some phone calls to follow up from your colleagues. And Stephen, I will go to you.
Well, thank you. Picking up on what others have already said, but adding a couple of novel points. I think this is in some ways uncharted water, and it may well require some novel approaches by regulators, especially those at the state level, to make sure that the newcomers, the new entrants, are adequately protected. But it's also true, as I've said before, my mantra here is that more than financial literacy or improved disclosure, you need affirmative guardrails and obligations. And to apply those in this context isn't necessarily that difficult. And I would cite the analysis in part of the Massachusetts administrative complaint, where in essence, they come out and say, look, a recommendation can be an explicit recommendation, or it can be achieved and made through much more subtle, frankly, psychological techniques. But in keeping with the history of securities law, what needs to be done is for regulators and courts ultimately to look at the realities of a situation so that clever tactics and techniques that are ultimately aimed at exploiting investors don't win the day. And those tools are there. And another example, frankly, is in the representation that Robinhood and other platforms are using increasingly of commission-free trading. I mean, that's something one could very easily argue is materially misleading because it's not in a meaningful way, and it actually hurts investors if that's what they rely on to come on board on these apps. So that's my pitch for guardrails.
So before I move on to my last question, I do want to thank each and every one of you for participating on this panel. It's been very engaging, lots of great discussion, and it was even more than I could have hoped for. So I sincerely appreciate every single one of you for devoting your time and sharing all your thoughts with us today. So here's my last question. I'm going to go in alphabetical order so that I'm fair. So I will start with Katrina on this one. So give me, and you have about maybe 2 minutes each, minute and a half. Give me your takeaway from the GameStop saga.
Sure. Thanks, Marnie. I think to stay within the confines of my time requirement, I think the knee-jerk reaction is to assume that there was misconduct and think about, well, is there going to be enforcement action, or if that's a stretch, and if no existing rules have been broken, do we need to plug gaps? Do we need rules to address these things? Like how should we prevent this situation from happening again? And, it remains to be seen how that will all play out. And there may be some truth to that, but I think that we need to take a step back as regulators and, really look at how all the things that we've been talking about today, how retail investors are trading and accessing information, and see how we can improve within our existing frameworks and address the concerns that arise from this new segment of the market. Do we need to monitor social media as part of our surveillance platform? We're looking at that. How do we reach investors to provide, investor education? We need to take out an ad on Reddit, maybe. There's ways to communicate with people based on how they're interacting with the world in this day and age. So I guess, my takeaway is let's not race to fill in gaps, create new rules, figure out what is missing, but look at what we have within the current framework and modify it to this day and age, and provide regulatory guidance in a new context, I think is important.
Thank you. Okay, Lauren, I will go to you.
So I think a big takeaway for me when I was, when I was seeing the trading in GameStop, I was assuming that these retail investors were being duped or mistreated or something like that. And then I stepped back a little bit and saw some of the chatter about that they were trying to express some of the investors were trying to express something different with their trade than necessarily the value of the underlying product. There was a not insignificant portion of the investors that wanted to stick it to the hedge funds, or that, you know, that they were expressing a view, but it wasn't necessarily a view about the fact that they were going to buy something for one price and hope to sell it for more later, that they were actually theoretically willing to incur the loss because it was something that they wanted to do for one reason or another. And that was candidly kind of mind-blowing for me, because I've always taken for granted that when somebody buys a stock, they want to sell it eventually, either that day or 20 years from now, for more than they bought it for. And so, you know, that was just another one of those examples of how the markets are doing all sorts of things that aren't necessarily what we traditionally may have thought that they do, and participants are engaging in them in unusual ways. And then when you combine that with, you know, the long period of very low interest rates, the savings aren't, you know, saving much money, and all the other things that are happening around applications and everything moving to the cell phone and social media, you know, it's just really kind of exciting times, I think, for people in our industry, because this is a lot of uncharted territories, and like what we said, you know, some of the themes are the same and the goal of investor protection remains the same, but these investors might not want the same type of protection, or might not be you know, willing to, you know, Robinhood tried through their blog to leverage the grassroots and the commitment of their clients against the securities division, who the securities division was trying to protect them. So, you know, I think there's just a lot of really interesting currents that are happening here. And I love hearing what Katrina said, because I think that there's a ton of space to be really thoughtful and strategic in kind of the approaches that we take, instead of having a knee-jerk reaction, so that the protection that is implemented is embraced and effective in the way that we would all want it to be.
So non-traditional reasons for investing. So Stephen, I'll go to you. So if you can about a minute, and then Ty, I'll give you about a minute. Unfortunately,
no, that's fine. Thank you very much. I've enjoyed this panel immensely, and thank you for moderating it so well, Marnie. Three things. Number one, this is an amazing fact pattern. This GameStop, Robinhood disarray and frenzy, and it really does illustrate some serious structural defects in our securities markets. And unfortunately, the trends seem to be headed the wrong way unless we tackle them in the right way. Number two, I think it's only fair to let whatever investigations, inquiries, analyses are underway at the SEC and elsewhere to unfold and get the benefit of what they find out. And also the benefit of proposals, thoughtful ones, hopefully, that come out of the SEC. We're hopeful on that front because it's under very strong and good leadership. And finally, I think the solutions, as we see them, not to jump ahead of the investigations and proposals that regulators come up with, the solutions are really at hand. I think it's not that hard to think about outlawing, banning PFOF and maker-taker. You can strengthen the duty of best execution relatively easily. You can deal with short selling, transparency issues. In fact, it's a mandate, and on and on. But if they don't get it right, and this goes back to Ty's point, it's going to be a bad development. And it's bad not just for investors who will suffer, but also for the integrity and vitality of the markets. And they really are a terrific engine for capital formation and prosperity, but they can do immense damage if we can't turn things around on some of these important issues.
Hi, the rest of the time is yours.
All right, I will move as quickly as I can. I want to pick up where Steve just left off, because this is about capital allocation and protection of investors and driving the economy forward. We've made it faster, easier, and cheaper to trade more complex, risky stuff than ever before. And at the same time, we have more people coming into the markets, more minorities, more women coming into the markets than ever before. this should be fantastic time. What that means is we have to do better on education. We have to do better on guardrails than we've ever done before. And just recognize that those accounts, at least right now, aren't going anywhere. There are millions of accounts that got set up over the last year on Robinhood, and they're going to trade. They're going to trade what's hot. And to go back to what they see. So we're going to see, volatility is a feature of this market going forward. It is going to continue. We are going to see more of these types of things, not just in meme stocks, but in just everyday stocks. So we have to recognize that our markets are fragile and they're going to keep moving. So I do think at the federal level, we're going to see a lot of focus on, my 7-year-old has some thoughts. We're going to see a lot of focus on conflicts of interest and reducing those things and some of the things Steve mentioned. But at the state level, I would say, think about the basic levels of customer protection. It's not just what's a recommendation. It's not just on the front end. It's also on the back end. It's how can we make the interface for these customers work better so that they know they have a better understanding of what they're doing on the front end, but also when things go wrong as they're going to do, they have the protections on the back end. So what are the states going to be able to do to say, you have to be able to get a hold of somebody. You have to be able to get a better understanding of the disclosures, physical copies of disclosures, manageable and understandable things, sort of thresholds before you end up trading call options at a traffic light. Thank you so much for the opportunity. Thank you so much for your moderating, Marnie. I really appreciate being here.
Thank you, Ty. That is a great way to close. And I'm glad we were able to get your final point in. So again, I just want to express my thanks for your participation on the panel. And President Hopkins, I turn it back over to you to close.
Thanks, Marnie. And thanks to all of you. That really was an excellent discussion and obviously so timely and informative. Well, that concludes NASAA's 2021 Public Policy Symposium. I hope you've enjoyed the afternoon. I know I have, and I really appreciate all our speakers and our audience for joining us this afternoon, and we look forward to seeing you all in person in Chicago at our annual conference in September. Thanks, and have a great afternoon.
Terrific. Thank you.